Welcome to Everything CPA and private equity, where we unpack the evolving relationship between accounting firms, private equity, and other strategics. I'm David Wolfskehl, a partner at Whitman Transition Advisors.
And I'm Phil Whitman, CEO of Whitman Transition Advisors. And we've chatted with more than 150 private equity groups. We've actually closed over 40 transactions with those private equity groups. And we're bringing you firsthand insights from the front lines.
And whether you're exploring your first deal, putting your toe in the water, refining your strategy, we're here to guide you with real stories, expert advice, actionable takeaways. Let's dive in. So happy to be here today with Nishaad Ruparel of Ascend, and a friend of ours, somebody we've done business and somebody who's really shaping the marketplace. So we're so lucky to have him here with us today. And this is another episode of Everything CPA and private equity. And we're here to educate leadership teams on what's truly going on in the marketplace. This was all started from the PE Summit. And one of the things that we knew from the first PE Summit was firms needed education. And at the second PE Summit, I would say that need continues. So this is all about bringing resources to leadership teams. Phil, why don't you introduce, I know you've been working with Nish since day one. Why don't you introduce Nish to our audience and we'll get going.
Yeah, so I'm going to leave, Nish to give the details of his background, but I do want to say it's kind of amazing having worked with the Ascend Together team before they were even Ascend Together, when I thought I was working with a group called Alpine. And what they've done, they've made some amazing moves in our industry, and I really believe in record time. But, Nish, we've sort of come to a really nice friendship, getting to know one another over the past 2.5 years. And I'm just so impressed what he's done. But Nish, why don't you share a little bit about yourself, your background, how you got where you are today, and we'll jump right in.
That sounds great. David and Phil, thank you for having me back on the program. The two of you, Terry, David Kells, others at the Whitman organization have been really generous with your time and advice as we've grown Ascend in the profession over the last couple of years. And I saw in your little logo there that you've dropped transition out of Whitman Advisory, and that's very cool. It's very fitting. You all do a lot more than that. So thanks for your time. Thanks for your generosity. Yeah, that was a great introduction. My name's Nish. I'm the president of Ascend. And my role at Ascend is really to shape the organization through M&A. So Phil, you kind of alluded to this, but over the last 3 years, Ascend has completed about 40 M&A transactions. And in doing that, we've allocated over $1 billion of investor capital through that M&A motion. And there are a lot of decisions that have to be made that sit underneath that, right? Which firms to partner with, how to approach valuation of those firms, how to structure those transactions, and then critically integration, which is probably the most important part of that supply chain. So I facilitate and guide the firm through all of those critical decisions. And my background is in investing, which is a really helpful discipline to be able to do that hopefully well. But candidly, I get the most energy from my job and from my role because I actually get to meet every single partner that joins Ascend through a transaction. So in a very grassroots way, I feel I have this unique privilege of shaping the leadership and cultural foundation of our business through that capital allocation motion. So we've known each other for a couple of years. We got started really as a ground floor enterprise with $0 of revenue, just looking to build an independence model in the middle market. And that was in January of 2023. Roll the clock forward to January of 2026. We've got 23 partner firms, quickly approaching $700 million of revenue, and quite a lot of resources, shared services, transformation, tooling, and community that sits underneath all of that. So it's been a joy. It's been a privilege.
And Nish, you just talked about, you just had your kickoff meeting just a couple of weeks ago. So why don't you share some of those things that the team and yourself are excited about for 2026? Because I'm sure that was a big part of the kickoff.
It was. It was. Last time you had us on the program, I think it was February of 2025. Sure enough, that was right after our 2025 kickoff partner summit meeting. At that time, we had just cracked the top 30. I think we were a $350 million firm with 13 partner firms underneath that revenue goal. a revenue number. And to kick off 2026, we were, as I said, a $700 million organization with 23 partner firms. So the first thing I'll say is the way that that room looked and felt was really different, just a few weeks ago than it was a year ago, or certainly the year before that. The other thing that was really big for us over the last 12 months is we invested a ton in some really important transformation tooling. So AI is really front and center. We spent capital last year on some proprietary AI software that's being forward deployed across our firms right now. And underneath that is some really important technology integration, enterprise technology integration that powers that AI. So that was a big focus of this summit. The product that has come to market out of all of that investment, the way it's going to be used in the upcoming busy season was, I think, really exciting.
I know one of
Uh,
the things you spoke about last time was you believe AI will be a winner loser column, right? If you're behind on AI, you're probably going to be in the loser side. And today it's going to be AI moving forward is going to be a huge criteria for winners and losers in this marketplace.
Yeah, I do. I do think it's critically important. And, the fundamentals of that are just the fact that so much of the profession is retiring in the next 10 years, and yet the demand for public accounting services continues to grow. So if you have a growing market with fewer and fewer people, what it means is that every person has to get quite a lot more productive. And, I don't think anybody's looking to work two or three times as hard or as long 10 years from now. I think folks are really looking for leaps and bound improvements in productivity and to spend a lot more time providing trusted advice versus, workflow that can be monotonous and redundant. So we're investing behind that in a really big way. Maybe the second theme that I would touch on is we have an independence model that's pointed at the middle market. And one of the advantages of that is that our firms are really embedded in the fabric of their community and they serve families, high net worth individuals, closely held private businesses in a deeply personal way. And we as a holding company have a lot of data and client intelligence that we spent the last 12 months gathering so that we could support our firms in creating better retention, better service outcomes, better ways of engaging with those customers and building durable, lasting relationships. And so quite a lot of the summit was actually focused on how to serve your local market context.
Right. And, you talked about that you're the holding company. So why don't you talk a little bit about equity quality, right? All those things about what being part of Ascend is and what's special about that and different about that.
Sure. Yeah, so you hit on a really important word there, David, which is, equity and equity quality. And, the folks that choose to join Ascend and become Ascend partner firms, they're basically giving up their ownership in their firm for ownership in Ascend. And that's a really important choice that they're making. They're also giving up on behalf of their young people, the chance to become an owner in a local independent firm with, effectively once they join Ascend, becoming an owner in Ascend, right? So it's not just a choice you're making for yourself, it's a choice that you're making, for generations of people that aspire to be partners at your firm. And therefore it's a very important choice. I think to understand like the pros and cons of that decision is probably helpful to look at the partnership model as a starting point. And the partnership model has been the way that the profession, that the industry has chosen to organize itself over many, many years. And, so if you're an owner in a partnership, when you reach retirement, you sort of monetize your ownership at something like three times comp. And it's fixed in your agreement. It's paid late in life. And the way that it grows over time is essentially just the earnings growth of the firm, right? So it's a three times multiple and it maybe grows at 5 to 7% a year if the firm is growing at 5 to 7% per year. And I think that has worked for a very long time. But something that's true about it is that it's priced to be affordable, right? It's priced to, make internal succession something that's accessible and can be a reality generation after generation. If you sort of step out of that paradigm and you think about what Ascend and other organizations that are organized more in a corporate model than a partnership model are able to provide. Number one, the multiple on your income, the multiple on your earnings is much higher than a three. And number two, the growth rate is not 5 to 7%. The growth rate is a combination of your organic growth, your inorganic growth, how you capitalize that growth, and then the economies of scale that may lead to a higher multiple down the road. You're actually seeing share prices compound at 25, 30, 40% per year versus income in the partnership model that's compounding at 5 to 7% per year. So you have a lot of firm leaders that are looking at their young people and saying, "Man, we wanna retain this talent. We wanna deliver a bright future for them, but do we actually believe that, 3 times comp 20 years from now is going to get it done, particularly when we're having to make so many investments with our excess profits just to keep up, right? Can I get a young person, to say yes to that future?" I think that question is being called into question and being discussed really actively. So on the flip side of it, at Ascend, we try to deliver all those advantages that I talked about in terms of, really high earnings growth, but also it's a value of ours to make sure ownership itself is broadly distributed across the organization.
And so if I'm a young partner or a young up and comer, right? Tell me, what that might look like. Why is being part of Ascend a win for me and my family versus staying in that partnership model that the first 15 years of my career were under?
Yeah, I appreciate the question. I think there's a really important part of the question that's actually non-financial. And most of the young people and the young partners that work at our firms are very talented and have had lots of opportunities to join top 10 firms, top 20 firms, top 50 firms over the course of their career. And they've said no to that many times. Many of them have actually left organizations like that to come work at regional firms because they felt that their impact could be greater, that the culture resonated a little bit more, and that maybe they could bend the curve of professional development to, accelerate further faster. So one, I think, really important part of Ascend is that we preserve that independence. Like we are a middle market firm built around, everything that is precious to the independent firm, client strategy, the way that they organize their culture, the values that spread through the organization, that those characteristics are made permanent rather than being compromised. So unfortunately, one of the trade-offs of being an independent firm over time is that you lack the economies of scale, right? So what you get in culture and leadership opportunity and client service, you sort of compromise in your ability to have the best tech stack or the best recruiting team or really be on the frontier with new technology like AI. And for us, as a $700 million collection of independent firms, we have quite a lot of horsepower and firepower that we can point at solving some of those challenges that have existed for a really long time. So you get, the independence that you hold sacred, but you're also empowered by economies of scale that you never had before in a community of like-minded firms. So that's, your question about why is life better? I think that's the non-financial answer to it. The financial answer is, if you had to make partner to be an owner in the old model, we actually hand out ownership much sooner than that. We've decoupled the idea of being a partner from being an owner. So you can be a shareholder of Ascend, 2 or 3 levels below, before you're ever promoted to partner, which is a great thing. Once you become an owner, your shares are compounding forward, right? You can buy more each and every year until the time of your retirement, and those shares are compounding at some rate of return every year between now and then. Conversely, in a partnership, you gotta wait a long time to get your ownership, and then you gotta wait a long time to reap the reward of it. So you're doing a discounting exercise instead of doing a compounding exercise. And if you stack that up over the course of a long career, it can be extremely meaningful for young people.
And I think another non-financial, and again, we used to talk in mergers, it starts with chemistry and culture. The non-financial makes people happy. If you pick the wrong place and the finances work and the non-financials don't, you're very unhappy typically, even if you received a lot of money.
You mentioned that in the past and in the partnership model, it's discounting versus in your model, it's compounding forward as opposed to discounting backwards. If I'm one of those young folks and I really want to do a deep dive, because I hear all the time, and
All
I'm in
the
these
time.
meetings every single day. Yeah, sure, it's great for, the older guys. They're getting a boatload of money. But what about me? I'm a 35-year-old partner and, I'm not getting that money. And I'm also not going to have the opportunity to make a 7-figure salary the way those guys did. How is this possibly good for me? So now maybe I'm not that up and comer, but I am. I'm a young partner who had aspirations of one day taking over for the leader of the firm and
Yeah.
making really big dollars. Obviously, I think packed into my question is, you know, I'm a 65-year-old. You allow, I'm actually 64, but for this example, I'm a 65.
Yeah.
Okay. I rounded up. But let's say I'm a 65-year-old and I've got a shorter pathway, and you decide that we're the right firm for you to partner with, and we have some youth at the firm. There's the concept of cash. And I know when you buy the firm, they're trading their shares, they're selling 100%, but they do have an opportunity to have rollover equity, you know, uh, take some of those dollars and invest into the future. What do you do? Like, I'm an old guy, and if you're going to give our firm 10 or 20% rollover equity, what do you do to make sure that the young guys aren't sitting there saying, God, Phil's taking most of the money and he's taking a lot of the rollover equity. And what gives for me, the young partner that, as I said, was hoping to have a long future at the firm?
Yeah, it's such an important question. Let me just grab onto a couple of things that you said there and respond kind of to each one. So, you know, the first thing that you said is you sort of painted this image of a young person saying, "Hey, well, I wanted to run the firm one day, and now I'm not going to have that opportunity." Right? And that's not financial. That's just, "Hey, I wanted to lead in a certain type of way, and is that opportunity for leadership going to look different or going to be there at all?" And I think one of my favorite parts about the Ascend model as a family of regional firms is that you will have the opportunity to be managing partner of your firm. The 23 firms that we have across the country, maybe they're on average 30 to 40 million dollars in size today, but each of them has aspirations to be an order of magnitude bigger. And they see the path to getting there in their market. And of course, that's going to take deep local expertise and deep local leadership. And I could probably list off for you a couple dozen names of young partners across these firms who I know aspire to be managing partner. And so a big source of energy for me in my career is getting to watch them grow, getting to watch them lead, and knowing that opportunity is going to be there for them. So first, I just want to hit that. The second thing that you said was, "Gosh, I was imagining myself making seven figures one day, and now we're going through this transaction, and compensation's being scraped, and who knows where that ceiling is." And so, what kind of cash opportunity is going to be available to me? My response to that is, you know, the market's growing 5 to 7% per year, and 75% of practitioners are retiring. So there is quite literally three times the amount of revenue per person that we're stepping into over the next 10 years as compared to today. So if you can use technology to make that productivity leap, your profitability as a firm by definition is going to be an order of magnitude better than it is in today's environment. And so that seven-figure compensation potential, it's not going anywhere. You just need to be partnered with a firm that's really clear about how that gets redistributed back to you and what that earnings potential looks like. And so at Ascend, we try to lead with clarity there, and we've tried to put programs in place that keep cash compensation extremely competitive because it's really important. It's work at the end of the day, right? It's a livelihood. And then to your final point about like how does the cash versus stock in a deal get distributed and what are the incentives of whether, older retiring partners are hanging on to a lot more of the economic value and not, putting it in the hands of young people. I think you're putting your finger on a really important topic. And one way that we try to navigate that is to partner with firms that have a vast majority of folks who are younger, who still have 10 or 15 years left in their careers. And I think we've been able to do that very successfully where many, of the last dozen or so firms to join, have had on average 10 or 15 years till retirement. So that grab the bag, conflict is not really there at all. If it is there in any way, one of the things that we really like to see is that the leaders of the firm are disproportionately shifting value down to young folks, rising stars. And we don't, frankly, because we develop these relationships over a long period of time and feel very aligned from a values and strategy perspective before we make that partnership decision, we're not having to push partners to reallocate, you know, extra cash proceeds or extra equity proceeds in the hands of young people, they're oftentimes doing the transaction because they see how bright the future is and they're wanting their young people to participate in a really significant way from the get-go. So if you're a young person stepping into a situation like that, I think it's extremely important to have clarity around how each of those things are going to be available to you. Opportunities for leadership, opportunities for cash compensation growth, and ultimately, you're going to build your ownership position in a new firm, a new entity. So, not just opportunities to build your position, but opportunity for that position to be worth something a lot more in the future than it's worth right now. And there's some tire kicking that has to happen to make sure all of that is actually there.
I would also think if you're having issues with sharing equity and things of that nature, that would probably be a red flag for you organizationally as well, that maybe they're not the right partners because values are so important, perhaps.
That's exactly right.
And one other thing, Nish, that we frequently hear, obviously, as you know, with Blackstone coming in and taking New Mountain out with Citron, and there's been a whole slew of private equity groups that have said, "Hey, those guys are in it. We ought to be in it."
Yep.
And we're now seeing tremendous competition, even going down to small firms, like you and I were talking about 26 being the year of the tuck in, the 2 million, the 5 million, the $10 million firms. But, one of the things as CPA firms explore the vast, canvas of opportunity, there are firms that offer their equity at Popco,
Yep.
and there are groups that offer it at the local level. And I'm sure those that offer it at local level try and explain why they think it's better at the local level. And organizations that do it at Topco explain why they think it's better at Topco. Why don't you obviously share with Ascend, your model and your thoughts on why the Ascend model is a superior?
Yeah, I'm happy to do that. I'm happy to do that. I like that you started with the Blackstone Citron Cooperman transaction and headline because I think what it represented for a lot of people in the profession was some validation that private equity's investment in public accounting has legs and can be meaningful. And look, there's value on the other side, so to speak. And it's funny, like my first Accounting Today PE summit, I would describe the preeminent feeling in the room as like curiosity. And in 2025, the preeminent feeling in the room, uh, it was a lot more declarative. It was a lot more like, "Hey, this is working." And on the one hand, I think that's great. On the other hand, I actually would caution the market, and let me just elaborate on that for a second, which is 5x in 5 years seems to have become the prevailing narrative around what your equity is gonna be worth. And I just like there is no broad substantiation for that. Like, I spent my entire career in private equity, first as a banker covering the industry and later as an investor, working in it. The long-term average is more like 2 to 2.5x, right? And so let's break that down. 5x in 5 years, what does that actually mean? It means you're achieving a 40% rate of return, right? 40% rate of return. The public accounting market is growing at 5%. So you have, to your point, Phil, 43 private equity firms, that's the number the last time I checked, pursuing a few hundred public accounting firms. Uh, Telling them that they can convert a 5% growth rate into a 40% return annually. And I think folks should really investigate, how that gap is bridged. And it can only come from a few places, right? You can either grow faster than the market. So let's say your organic growth goes from 5 to 10%. That's the first place it could come from. The second thing is you can do more M&A. M&A creates value. The third thing is you can capitalize yourself, with different levels of risk tolerance, and that adds value depending on how you fund this stuff, equity, debt, cash flow. And then the fourth thing, like I said earlier, was valuation, economies of scale. So a bigger business might trade for 15 times and a smaller business might trade for 5 times. And so that's ultimately how that 5% rate of return gets bridged to 40. But are 43 private equity firms going to navigate that bridge successfully in the same market all at the same time? No.
Now we're going to have winners and losers.
Exactly. Definitionally, there will be winners and losers. So I think, before you even get into like local equity versus, top co-equity, I think track record and the eye test and kicking the tires on strategy, I think it is of the utmost importance.
Wait, I'm sorry to interrupt you, but you said kicking the tires on strategy. I was going to say the fifth way to achieve that 40% return would be by becoming a Bitcoin treasury and putting no, you did say strategy. I had to throw that in. I'm sorry.
That's funny. Yeah, crypto is a bit of a black box to me. So maybe there's a
Yes.
fifth, sixth, and seventh way to do it, but
Yes.
but I won't speak about that. So then getting to your exact question of like parent company versus local entity. Look, I think the local equity model, I understand why it's compelling to people because there's the, emotional benefit of, hey, I'm still an owner in my firm. And there's the familiarity of, hey, I still get paid a really healthy distribution. And then there's the feeling of, control that, I'm ultimately monetizing something that I interact with every day versus something that is much bigger than me. And so it feels more controllable versus out of my hands. But there are some challenges with that model. If you're committing to pay firms distribution and you're committing to pay your lenders interest expense, like I do question how much money is left over to really build the shared services that are required to power all the transformation that's necessary to reach that 3x gain in productivity. So one of the most important reasons we didn't choose to organize ourselves that way was because we wanted to retain the free cash flow to build these critical points of integration and invest in transformation tooling that we thought was going to be necessary. But the other comment that I would offer on that is I think so much of the value of Ascend actually sits in the intellectual property that's being created and shared by all. Right? A new client won at our Vermont firm adds value to all shareholders. An M&A deal that our Wyoming firm does that brings them into Teton County, which is one of the most prosperous counties in the state of Wyoming, that adds value to all shareholders. The AI product that we're building in Vancouver adds value to all shareholders. So you're not getting the average outcome. You're actually getting the sum total of all outcomes that are existing within the Ascend family. And as a common shareholder, you're motivated to participate, in the whole thing. I understand that there are 31 flavors, as you've pointed out to folks many times, Phil, but we've tried to be extremely thoughtful about how we've designed our model, and it's designed with durability in mind.
And I think that durability, and we'll ask one or two more questions. Thank you so much for your time. We want to be respectful. But the way you set up with the interactions with the PE firms and the Send, right, is also a little bit different than many of the models out there. So why don't you share how Ascend is and how Ascend stays? And, investors may change over time. And I think that's a unique flavor of our 31 flavors. So why don't you share a little bit about that?
That's like putting the cherry on top, you know?
You nailed it. I don't know that I have too much to add. But I'll maybe say this, which is there's a lot of firms that are debating partnering directly with private equity, right? Particularly firms of a certain size that feel that they can support that and that they have the leadership team and the operating team to really do it. And the thing to be sober about if you make that choice, there's two things to be sober about if you make that choice. The first is you're really just getting money and expertise, right? I sat in the private equity seat for a long time. We weren't building AI products on behalf of our companies. We were writing equity checks. We were attending board meetings. We were trying to facilitate best practice share. But ultimately, it was on the management team of the firm that we had invested in to really build those resources, build that infrastructure, manage those projects, which can take a long time and require real expertise. So that's the first thing to be sober about, which is if you partner directly with private equity, you're going to be doing a lot of the building yourself. And that's okay. Some people really want that. The second thing to be sober about is you're moving through a one-way door. So in the past, you have managed your balance sheet through a partnership, but in the future, you're managing your balance sheet with an institutional investor that resides on that balance sheet, that has information rights, that wants monthly financial reports, that attends quarterly board meetings, and they may be, and they likely are going to be a very value-added partner. But the motion of investor relations is a motion that you are going to be doing for the rest of your firm's existence. And that when you're done leading the firm, somebody else will inherit that motion because institutional capital finds the next institutional capital owner to realize a return on their investment. And that cycle doesn't really go backwards, it only goes forward. So those are the two things to be very aware of. With Ascend, neither of those things are true. Right. And it's not better or worse. It's just kind of factual in the way that we've tried to design this, which is we are handling the infrastructure bill at Ascend Partner Services. It's a team that now includes over 100 people. There's a leadership team that has annual plans for what systems and capabilities we're building in 26 versus 25 and so forth. So our firms don't really have to kind of deal with a lot of that construction. And then secondly, as it relates to managing an institutional investor, that investor relations motion is also handled by the Ascend management team. So that's your comment, David, that investors will come and go and we will create opportunities for our CPA partners to have liquidity over time. But none of our firm leaders are walking through a one-way door where they're managing an institutional investor for the rest of their careers. And I think a certain subset of the market that is particularly focused on their community, their local client service strategy, building juggernaut firms within their markets. They like that fact that, the capital can be a feature without having to be an obligation.
Thank you.
I have a quick question before we wrap up, and you can answer this however you like. So at
Yes,
the private equity conference, there was some talks that 2026 was going to be the year of the flip. Now, and what that means is there are several organizations, including yours, that have been at this for some time. And there's a possibility that, there could be that proverbial second bite at the apple. And the question that I would throw out to you, and again, there's no pressure in this question, because I have my own beliefs. We've heard that Eisner Amper is most likely going to be doing a continuation vehicle. And perhaps maybe you can explain for those listeners of ours that don't know what a continuation vehicle is, what that is. We know Cherry Beckert is also at a point where there's a possibility. We know there's you, we know there's Crete, and there might be one other. But I'm kind of sensing, my sense is it's probably not going to be the year of the flip. To me, the year of the flip would be, all 4 or 5 of the initials that got in at the same time or having their first turn. Love to get your thoughts.
Yeah, thank you for the tee up. Gosh, 2026 is the year of many things, depending on who you ask. Look, I think for us, and it's a very forward-looking question. Last time you asked a similar forward-looking question at the end, and I think the prediction that we made was that 2025 would be the year of the haves and the have-nots, right? People that have fixed the ownership challenges, that have access to resources, that have access to capital, versus firms that are a little bit slower to make those changes. And I think that has proved out to be true. In sort of 23 and 24, there were about 100 transactions per year in public accounting, and in 2025 there were about 220. So we are certainly seeing the acceleration that you all have been talking about, and we kind of collectively put our finger on a year ago. My prediction for 26 is, I'll give you kind of a business prediction first, and then I'll talk about the capital markets element of it that you're alluding to. My business prediction is, look, those 220 deals that got done in 2025, there's a lot of folks that are chasing national resources. And so you have very local firms in markets like Louisiana and Alabama and Utah and other places that so desperately want national resources and national scale that they're collapsing their tax and audit and CAS service lines into national reporting lines through these merge up transactions. And one of the things that they're losing in doing that is the ability to service their clients with a local constitution. A client calls and it may or may not be the old person that picks up the phone. That call can get routed in any direction across the country, from a service line perspective. And I think the flight to be a have and not a have not is coming from the right place. But my prediction for 2026 is that local context, local expertise, being part of the fabric of your community, I think it creates better outcomes for clients. I think it creates better outcomes for people. And I think that if you want to build a durable business in the middle market where those things need to be true, it's hard to ignore that your community matters. So my prediction for 2026 is that, community matters in the middle market. And if you take the long view, I think there's a middle market opportunity in public accounting that exists much longer than 1 year, 2 years. Like we sort of have a multi-decade time horizon in the way that we're approaching it. It's on our mind that some folks have bet on us for 3, 4, 5 years and counting. And, being able to deliver a win for those folks is an important proof point in, the continued success of Ascend. So it's not that that day will never come, but we're still focused on our strategy and our operating principles heading into this year.
Awesome.
Well, thank you, Nish. As we wrap up, we asked you lots of things. Is there anything we missed? Any points you'd like to share with the audience?
It's probably not best practice, David, to turn that opportunity down, but I feel like I've talked for quite a bit, and I feel like y'all asked some really great questions. So I'll just share my gratitude with you for having me back. I really enjoyed it, and it's good to see you both.
We love having you. I went to high school at the same high school as Nish. Probably the only time every year that I think of it is when I see Nish.
Go
But
Hawks.
it makes me smile, at least for a moment, and appreciate you, appreciate Ascend, and really doing things like this, because this is really helping our audience, right? And you're bringing value and bringing insight. So very much appreciative of that. And for our audience, if you like what you're hearing, subscribe. If you have questions, we're helpers. We know a lot of people. We've seen a lot of things. Feel free to ask us a question. For everybody, go crush the day, and thank you. And thank you again, Nick.
Thank you, Nish.
Thanks, David. Thanks, Bill. Appreciate you having me on.
Thank you for tuning into Everything CPA and Private Equity. Every episode brings fresh insight. However, there's always more to talk about. Don't miss an episode. Subscribe wherever you watch podcasts. Have a question or topic you'd like us to cover? We'd love for you to reach out to us. Together, we will help you navigate this dynamic landscape so that we can help you achieve your goals. Until next time, keep making moves that matter. Thanks for listening, and we'll see you on the next episode.